All right, good afternoon. I think we'll go ahead and get started here. Want to thank everyone for joining. My name is Ben Onukwube. I am the owner of Star Nsurance Tax on East Fletcher Avenue here in Tampa, Florida, and super excited to spend a little time talking to you about how to armor your business, right? We want to focus mostly on setting up the right entity, making sure that you have the right protections. At Star Nsurance Tax, we service a lot of small business clients, gig workers, um, people of that sort. And one of the things we think about a lot is how do we make sure that our clients can protect themselves financially and make sure that they have the opportunity to see their business grow and be able to give more of their time and themselves to their business. And so that's what inspired this conversation. We understand that really thinking about your entity structure and how you create those legal protections and optimize for taxes can be hard to digest and understand. So our hope is that through this presentation today, we will give you some clarity and some things to think about as you are making those decisions and stepping into your businesses as small business owners. It's something that we love to see. People step into their passion or their creativity or be able to generate value off of their own ideas. And so we want to make sure that you can do that in a sustainable way. And that begins with armoring your business and protecting yourself financially and also finding some tax optimizations where possible. So before we jump in fully, I've got to go through a little bit of the legal mumbo jumbo. Essentially what this is saying is, look, we work in this space, but we are offering information. We are not giving you advice. We're not necessarily telling you what you need to do in your unique situation. We just want to make sure that you have some clarity and some understanding to be able to make the right decisions as you go about setting up your business. And if we can help you do that, we'd love to. So, two critical areas to think about when you are thinking about stepping into creating a business. You really want to be thinking about, do you have the legal protections in place to separate you personally, your personal assets, your personal finances from the liabilities and the risks of your business? And then the other category that you want to think about is, how are you thinking about tax treatment, right? We start and we run businesses with the hope of generating value, and we want to keep most of that value and be able to deploy it into growing our businesses, taking care of our employees, supporting our communities, whatever your intentions are. And so thinking about how different entities, different business structures get treated from a tax perspective is also really important, right? So when you think about legal protection, think about creating an entity that creates separation between you, your personal assets and aspect of your life, and your business assets and liabilities. We want to shield your personal savings from business debts and liabilities. We want to be able to protect your personal side of the house from any financial claims that may be levied upon your business or any legal claims that may be levied upon your business. And we want to essentially create a recognized business identity and brand that is separate from you as an individual. On the tax side, we want to think about, are we going to go with a pass-through tax entity, or does something like double taxation, a C-Corp, make sense? Spoiler alert, rarely does it, but we'll talk a little more about that. You need to think about self-employment tax considerations, right? A lot of people don't really think about the impact of self-employment tax until it comes to tax time, and then they find themselves surprised, right? Their business did okay or better than okay, and then they realize that they've got a little bit of a tax hit. We want to try to eliminate those surprises for you and for our clients. And then, of course, there's different mechanisms for how you can compensate yourself as a business owner and break that income up into categories that help to optimize the tax burden that you might run into. So the first question is, what happens if you do nothing, right? You hear a lot today, you've got an idea, you've got you got a willing buyer of your service or your product. Just get to it, right? You can catch up on the business entity and all of that, all of the formalities later. The most important thing is your business making money? Do you have a client you can sell to? And I don't necessarily disagree with that information, but I want you to just be aware of what happens if you do nothing. By default, if you start operating as a business, you, through the eyes of the IRS and state departments of revenue, you are essentially a sole proprietorship. We label this the risky default, right? It is the default situation of anyone who's running a business or earning income outside of working for an employer, W-2 employee, right? So now what do you need to think about if you are a sole prop? That's the term we use for short. Remember our two buckets, right? We're thinking in terms of protection, legal protection. We're thinking in terms of, tax liability, right? On the protection side, you've got almost none for personal protection. The sole proprietorship does not separate you, the individual, from your business operations. So that does mean that in the event of an accident, a lawsuit, a liability, a levy, a lien on assets, creditors, clients can come after your personal assets. You are fully exposed to the business debts and lawsuits because there is no protection or separation. On the tax side, it's pretty simple, right? Your taxes pass through, which is a term that you hear. What that means is the income of the business is not taxed on a separate return or in a separate manner. The income is passed through to you as an individual, and it shows up on your personal tax return. Now, thing to keep in mind when it comes to this pass-through tax treatment is that your net income of the business, right? Your profits, you make $100, you have $50 in expenses, you have net income of $50. That net income of $50 in this case is subject to a 15.3% self-employment tax, right? That 15.3% self-employment tax is essentially, your Social Security and Medicare payments. When you work for an employer, you as the employee pay about 7.5% of that, and your employer pays the other 7.5%. But when you own a business or when you operate as a business, you are both the employer and the employee. And so this self-employment tax is essentially making up for that Social Security and Medicare tax that would otherwise be coming out if you were an employee who earned a W-2 and worked for an employer. But it is a 15.3% tax on your net income, and in addition to that, the income from the business is also going to be taxed at the income level, right? It's going to be passed through to your tax return. You're going to pay income tax on that. Now, that may sound like, well, Ben, what's the point of a sole prop, right? The pro is that it's a simple setup, right? It's very easy to establish the sole proprietorship dynamic because it's a default. You don't really have to do anything. You can get started selling your services or your products today, and you essentially have a business. But what you need to keep in mind is that, in a lot of cases, the risks can outweigh the simplicity of this business setup, because you do open yourself up personally to any legal claims or debts that the business may have. Before we continue on with the next entity, you've heard me talk about this separation of your asset protection and your tax optimization. I also want to create another classification, another point of clarification, which is understanding what's happening when you create an entity, right? Versus when you think about tax classification. As you can see, we're still on this same kind of, dynamic, right? Legal protection, asset protection versus tax optimization. When you set up an entity, that is a legal structure that kind of creates this barrier, this wall between you and your business. LLCs, corporations like C-Corps, these are recognized at the state level. You are telling the state that I am creating an entity separate from my person. That's what's happening when you establish a legal entity. That is separate from tax classification, which you can see here in the second piece, right? It's a little bit different. You're talking about, how do I want my entity to be taxed by the IRS? This is typically a federal election. You're telling the federal government It's separate from the state. You're telling the federal government, how do I want you to treat this entity that I've created at the state level from a tax perspective, right? And then the final step is over here under taxation types. You heard me allude to this a little earlier in our conversation, is does it make sense for you to have a pass-through entity, which can create simplicity by passing along the profits of the business straight to your personal tax return? Or could it make sense for, double taxation, which essentially means that you're going to pay a tax at the corporate level. The business will pay taxes on its income. And then you, as the owner or shareholders of the business, will also pay taxes on the dividends that are distributed from the business, right? And so you see how you end up getting taxed twice on the income from the business, because you're paying tax at the corporate level, and then you're paying it again at the individual level for the dividends that get distributed from the business. That's what creates that double taxation. C corporations are kind of rare, but I want to spend just a few minutes talking about them, because even at Star Nsurance Tax, we have seen some clients who come in, they're ambitious. They are trying to lean into the dream of owning something, creating value by starting their business. And one of the mistakes that we see happen is they go on to the state Department of Revenue website, they're looking to start their business. And probably what they intend to do is to create an LLC. We'll talk about that in the next slide. But they confuse that C of limited liability company to corporation. They think they're supposed to be a corporation. I want to start a corp, and maybe they just don't have a robust enough understanding of what they're setting up. And a lot of times they end up creating a C Corp at the state level. And that can have some interesting tax implications, because when you go to get an EIN, which is essentially the social security number of your separate entity of your business, you go to get that EIN and you tell the IRS that you're a C corporation, you're essentially establishing this double taxation dynamic, right? You're telling them, hey, I'm a C Corp. And what they say back to you is, okay, great, you're a C Corp. You need to file a separate tax return. We need to see tax paid at the corporate level. We need to see tax paid on any dividends distributed to shareholders. At the state level, you also have a state tax for C corporations, right? It creates a whole bunch of interesting dynamics and compliance responsibilities that I think for most of our clients and for most of the people that we've seen and work with are unintended. They don't mean to create a C Corp, but it's very easy to do if you don't have the right help or support, which we are happy to provide through our business. If you don't have the right support or help, you unintentionally create the C Corp, and then we've got to go through some steps later down the road to unwind that. So you almost certainly don't need a C corporation. There's some rare. It has its place. It can be necessary, but I would say for most people who are starting a business and just trying to get going and create that legal protection, C corporation is not exactly what you need, because you run the risk of double taxation. You introduce some very strict formalities around bylaws and regular minutes, and extensive record keeping that is probably more of a compliance burden than most small business owners are intending to sign themselves up for. So don't want to spend too much time here belaboring the point around C corporations, but it's just important to note that it is, we have found extremely easy to accidentally find yourself signed up for one, at least here in Florida, when you're setting up your entity at the state level on the state website. So what does make the most sense, right? What can create that separation of legal protection, right? Essentially building that wall in between your individual self and your business. And your best option is the LLC, the limited liability company, right? We label this one as flexible protection for the reason that we have listed here below, right? It gives you that liability protection. It sets up that wall in between your personal assets and the business's liabilities or claims on the business assets or lawsuits, for example. It creates that separation. but it also gives you operational flexibility. It doesn't have as many stringent compliance requirements as, say, the C corporation, which introduces, requirements around bylaws and meeting minutes and, extensive record keeping and storage to remain compliant. You've got flexible management and ownership and even profit distribution at the LLC level. So you're a little more flexible in how you get to manage and operate the business. You have fewer formalities, so you're less rigid than a corporation. And you still have the same tax treatment as when you're a sole proprietorship, right? So remember, when we talk about our legal protections, we see that we get kind of a plus in the legal liability protection column for LLCs, but we still have the same tax treatment as we do on the sole prop, right? So we don't put a check in the win column for the LLC. Not that it's harmful, but it is still the same treatment, right? So you see, for just a little bit more effort by establishing an LLC in the right way, you're already 50% better than you were on the sole prop, right? Because you've created this liability protection. You've put up this wall to separate your individual from the business, but we haven't changed anything on the taxation side of things. You're still a pass-through tax. You still get pass-through tax treatment. The net profits of the business are still going to flow to your personal tax return, and you are still subject to that self-employment tax. And that's not necessarily a bad thing. We'll talk in a few slides about how we can optimize for that when your business is ready. But for just a little bit more effort, nominal fee, depending on the state you're living in, it can vary. In Florida, it's about $125 for the most part to get your LLC established and registered with the state, and then you've got ongoing compliance like your annual report. But for just a little bit of effort, you get that liability protection, but your tax treatment still stays the same. Now, it's important to mention, right, because when we talk about that liability protection, it is an inherent part of having an LLC, and then that is the reason why most people want to establish an LLC, right, or an entity in general. You've got this business idea, you're out of the gates, you're running, you're trying to create value, you're trying to acquire customers, you're focusing on what it is you've got this passion and this opportunity to do. And you think to yourself, okay, I want to formalize that. I want to create this liability protection. So you establish your LLC, and that's an important step. But I want to make sure we talk a little bit about some pitfalls that can cause you to lose or jeopardize the liability protection that you get from having an LLC, right? And we sometimes see this in our clients, and it's rarely intentional. It's just, you started running this business, you're trying to grow it, you're trying to make something of it, you've got multiple plates spinning, and it's just easy to get caught up, doing some of the wrong things, right? One of the things that people tend to do is they create their LLC, but they end up commingling their finances. What does that mean? That means that they don't create a wall between their personal finances and the finances of the business, right? A customer comes through, they love what you're selling, they want to buy it, they Cash App you an amount, or they Venmo or Zelle you an amount. And instead of having a separate bank account set up in the name of your business, in the EIN of your business, which recall is the social security number of your business entity, instead of having a separate place for those payments to go to, they just throw it into their personal banking account or their personal checking account. And that can lead to commingling of finances because it doesn't create that separation of I am Ben the person versus here is my business entity. So highly recommend keeping your personal and business finances strictly separate. The account you pay bills out of, the account you receive revenue from, keep that separate from your personal accounting so that you create this barrier and you avoid commingling finances. Improper signing, right? So you started your business, you want to go sign a lease or you want to sign an NDA. Highly recommend signing as an agent of your LLC, right? Instead of signing contracts personally. You want to sign in the name of your LLC with yourself as a representative member or agent of your LLC, so that again, you continue to keep that wall as a barrier between your personal self and your business self, and you create that you create that formality of this is a true business that operates, independently of the personal assets of the business owner. And so that's another area that can be an easy miss is you get a lease and you just, you sign your name to it as opposed to signing it in the name of your LLC with yourself as a representative. Missing operating agreement. This is an easy one, right? It's a relatively straightforward process to get your entity set up. And you're busy, you get back to doing the daily to-dos of running your business, and it's important to establish this operating agreement. It's not necessarily a requirement, but it really does help to reinforce that separation, right? And even if you're the only member or owner of the entity, you want to reinforce that separation by establishing kind of the procedures and the agreement of how the business is going to operate and run, how you might dissolve, how you might consider adding new members. It's better to think about those things and get them down on paper on the front end than to run into some kind of hiccup for having a miss later, right? Maybe your business grows. Maybe you decide to bring on partners or investors and you want to be able to bring them in. It's nice if you already have an operating agreement established that doesn't deviate or blur the lines between yourself and the business or future partners in the business. And then the last thing I'll mention is registering in the wrong state, right? So I think you get online, you can hear a lot of gurus, you can read a lot of blogs that talk about maybe you should establish your business in Delaware or Wyoming, or maybe you should go establish your business in a low fee state, things of that nature. I would say in general, barring a few circumstances or a few strategic maneuvers that are a little more complex, it generally makes sense to just register in the state that you are going to operate in. Oftentimes you register in another state and then you have to create a foreign entity in the state that you're actually going to operate in. And so some of the benefits and perks you think you're getting by establishing your LLC in another state don't really translate because you've got to register in the state you're operating anyway. So save yourself the headache, save yourself the additional compliance burden, and just establish your state in the place where you're going to operate so that you don't have any lapses that jeopardize that liability protection, right? These first three are really important because there's a term called piercing the corporate veil, right? Which is in the event that you do have legal action or legal claim placed onto your business, if you've been commingling finances, if you have been signing as yourself personally, if you haven't established an operating agreement that helps to reinforce that separation, an attorney can request that a judge pierce the corporate veil and essentially drop the wall, drop the barrier that creates that separation from you personally and the business, right? And then again, you would open up yourself to being exposed personally. So when you have these misses or you fall into these pitfalls, you can subject yourself to potentially having that corporate veil pierced and removing that barrier between personal protection and the business. So many of you have probably heard about the S-Corp, and what we see on our side at Star Nsurance Tax is that sometimes people jump into the S-Corporation a little prematurely. It can be a wonderful tax optimization tool, but there are a couple of important things to know to make sure that you make this election at the right time and add it onto your business. The first thing that's really important is if you recall a few slides ago, I tried to create this distinction between your entity formation and then how you choose to be taxed, right? Many people think that an S corporation is the entity. That is not the case, right? You are still an LLC, or you could still be a C corporation. That is your entity. That is the state level business entity that you've created and formalized with the state. When you are an S corporation, you are simply making an election for how you want to be taxed, right? How you want your entity to be treated from a tax perspective at the federal government level, at the federal level, at the IRS level, right? So it is not the entity itself. It's an important distinction. It is tax treatment of the underlying entity, right? And you can make that election by having a professional or by yourself if you choose to go that route. Filling out Form 2553, there are some timing things to make sure you get right, which is why it's recommended to work with a professional and make sure you get submitted in the right order and the right timing. But there are also some compliance things you have to be mindful of, right? So when you make the S election, when you choose to be treated from a tax perspective as an S-Corp, there is a reasonable salary requirement by the IRS, right? And so this introduces a compliance responsibility of paying yourself as the owner, shareholder of the entity, a reasonable wage. You have to run payroll for yourself. This is not a maybe I run payroll or I should think about running payroll. This is a requirement by the IRS that you have to pay yourself reasonable compensation. There are all sorts of rules of thumb around that. But that is sometimes what we see is people leap into an S-Corp. They think that's where they need to be. They didn't get a chance to kind of run their questions by or really think about it strategically. And one of the compliance things that they miss is running payroll for themselves. That is a requirement that has to happen. If you are an S-Corp that's generating profits, you need to pay reasonable salary to the owners. But if you look into these last two areas, it does provide some great tax optimization, because we talked earlier about how at the LLC level, when it's just a disregarded entity that passes through your personal tax return, your net income, the profits of the business, are subject to that self-employment tax at 15.3%. Well, when you make the S election, only the reasonable wage that you pay yourself is subject to that self-employment tax. And you have the opportunity to take the remainder of profits as distributions, and those distributions are not subject to self-employment tax, right? And so you can see how if for example your business is producing say $100,000 in net income, if you were just an LLC disregarded entity, you very well may be seeing an extra $15,000 self-employment tax land on your tax return. Whereas if you make the S election, you can help to optimize by only paying that 15.3% self-employment tax on a portion of that profit as opposed to the entire amount. And so in that sense, an S-Corp can really be a smart way to optimize and potentially save on taxes when used and deployed properly. It can be a really, really strong tool, right? Making that election at the right time, right? But you got to keep in mind that you're trading, there's a risk reward trade-off. You're adding some compliance responsibilities that you need to stay on top of, but in return, you do get this kind of special tax treatment, this optimization for reducing some of the tax burden you might see. So we're starting to get to the end of the presentation. I want to leave some time for questions, so go ahead and get those in the chat if you're thinking about anything that you want to double back on. But I just want to touch on a few things, right? As you're making your decision, as you're thinking about your business, just keep in mind that this isn't one size fits all, and as your business grows, you have the opportunity to evolve your structure. We just want to make sure that we've got clarity on, what we're saying yes to when we pick a certain entity, and that we shift and grow and make those changes as our business evolves, as the financial structure of our business changes, as the partner structure of our business changes, as the profits grow, which is what we hope for when we start our business. We want to see our top line and our bottom line grow, right? So it's important to assess your business, make sure you, from kind of the ground level, you understand, am I going to have partners? Am I going to have investors? What makes sense here? What's my risk tolerance? What exposure do I have? Weigh the options of balancing your protection and your taxation with the flexibility that you need to run and grow your business, and to what extent you want to invite certain compliance responsibilities. It's always great to consult professionals. We are a small business. We love talking with small business owners and helping them make sense of what's possible, and helping them get the answers to their questions the best we can, and looking into things for them. And then being around to evolve as your business grows, right? Help you make the right entity choices and changes as your business develops. So we've talked about liability protection, creating that barrier, separating out your exposure on the personal side from your business side. We've talked about taxation. There's also some other ways to think about how you can armor your business, and insurance is another great way to protect yourself, right? Things happen. There are risks involved with running a business. There's inherent risk to running a business, but if you choose to be in the arena, as Teddy Roosevelt says, if you choose to be in the arena and to be in the rewarding but sometimes challenging fight of starting and running and growing a business, insurance is a great way to add another layer of armor to your business. And so when you think about things like general liability insurance, business owners policies, umbrella policies as an additional layer of coverage, as well as, depending on the service you're in, errors and omissions insurance, and then of course workers' compensation, you can find ways to better financially protect yourself and the business in the event of a legal claim or a lawsuit, or a liability on the business that you need to address. And so we can provide those tools. A really important thing to keep in mind is, if for our listeners who are in Florida and establishing businesses, if you are in the construction space, even if you are the only employee, you yourself as the owner, there is a workers' compensation requirement for just being the one employee of the business. I think typically it's once you get above 4 employees, you open yourself up to workers' compensation. But if you are in the construction kind of contracting space, it is just one employee, yourself included, generates a workers' compensation insurance requirement. So be aware of that, and definitely reach out for help if you need support there. Let me get to this last slide. So, we are so pleased to have the opportunity to share just a little insight on, thinking between an LLC and S-Corp. What's the right entity? What's the right timing? What are the benefits? Hopefully we've created clarity around that for you today. And if we can be of service to you as you are creating value, starting businesses, and you're thinking about, how do I armor myself? How do I do the right things? We want to be in your corner. We want to have you covered. We want to be your guy. And so we can help with things like entity formation, business insurance, which we just talked about on the previous slide. We can talk about tax strategy and preparation, as well as additional coverages like auto insurance at both the personal and commercial level, as well as health insurance if you are self-employed, running your own business, and you need coverage from a health perspective. We want to talk to you and help you get what it is you need. Now this time we got a little time for questions. Let me jump in the chat and see what we've got, so I can answer some questions and make sure everyone's clear on what we're talking about. So we have a great question here. How does the S-Corp election change how I'm taxed compared to a default LLC? And this is a part of my rental income. Excellent. So this is a great question. The question here is about, how does being an S-Corp versus just being an LLC change the way that I am taxed? And it sounds like the person asking this question wants it to focus a little bit on like rental income. So like maybe they own a rental property, right? Oftentimes people who are in the kind of real estate space, or they have multiple properties that they use for rent, oftentimes you will hear people put each property or each couple properties, depending on their risk threshold, into an LLC, right? They essentially want to create that legal protection, that legal separation around their rental property, which could be a really wise thing to do, right? So it's essentially a business. You want to create that separation from yourself and the property itself, or you want to relegate what claims can be made on any particular property without having to share that risk across your whole portfolio. So that's a really smart thing to do. From a tax perspective, I would say, without being, too specific, that it generally doesn't make sense to make the selection for a rental property that's in an LLC. You're fine keeping it at the LLC level. There's some interesting tax nuances there depending on what kind of investor you are, if you're passive or active, if you're a real estate professional. On the passive side, there are some exemptions there that would, keep you from being subject to self-employment tax on the rental income. And if you're not subject to the self-employment tax, then the S-Corp doesn't really provide you any particular benefit. It really just adds compliance responsibilities without giving you the specific benefit there. You're probably safe as an LLC that's a disregarded entity. Okay, hopefully that answers your question. And it looks like there is a little bit of follow-up to that question, which is, for multiple properties, is it generally better to use one LLC for everything or a separate LLC for each property or group of properties? Right, that's a great question. I alluded to it a little bit in my previous answer. Does it make sense to have multiple properties in an LLC, or does it make more sense to have each property in its own LLC? Again, this comes down to your risk appetite, right? What you're doing when you put a property into an LLC is you're essentially isolating that asset into its own kind of bubble. Think about putting bubble wrap around, putting bubble wrap in a box around that property, right? So if you have multiple properties in that LLC, then maybe property A in that LLC has an issue. It could open up risk and liability to properties B and C that are also under that LLC. Whereas if you have property A in its own LLC and property B in its own LLC and property C in its own LLC, you're putting walls in between each one of those assets that help to protect, right? Now you've got multiple LLCs to keep up with, right? That might be the con of that. You've got multiple LLCs to keep up with. You've got multiple annual reports to make sure you file and make your payment on time to stay compliant and stay active, right? So you've got some maintenance you have to do when you've got separate entities, but you are really creating and defining those barriers and mitigating risk, sharing risk across the portfolio. Okay, so it's really more of a choice. It's kind of your risk appetite and how much exposure do you want to have, balancing that with how much compliance and maintenance responsibilities you want to keep track of throughout the year. Let's see what else we have in our chat for questions. These are some really good questions. A listener asks, I have a business where I have employees and also subcontractors. Should that factor into my decision if I should go LLC or S-Corp? That's a great question. Whether you have employees or subcontractors doesn't necessarily drive whether you should be an LLC or an S-Corp, right? There are LLCs that are disregarded entities that do not make the S election, that have an employee or two, or maybe they subcontract work out for special projects, maybe for marketing, or maybe if they're in the construction or contracting space to do, maybe you have someone that you hire as a subcontractor to do tile work, for example, because you don't do it yourself, right? That doesn't necessarily drive your decision. You want to make sure that you are compliant and you do the right thing. If you have employees, you want to hire a payroll company. Make sure that you are running payroll regularly, you're making the right withholdings, you're filing the appropriate payroll tax returns, you're filing your state kind of unemployment tax, you're making sure you do all those things, and that you issue W-2s at the beginning of the year to your employees. And the same way that if you have subcontractors instead, you want to make sure that you're following, employee versus contractor requirements, including how they report in for time, how they set their schedules, things of that nature. And you want to make sure that you get a W-9 from your subcontractors so that you can issue a 1099 from your business to the subcontractor, again at the end of the year or the beginning of the tax year, to make sure that you're compliant and running that. But it doesn't necessarily determine, really what's gonna make the most sense is self-employment tax on the net income of your business creating an unnecessary financial burden that you could optimize for by making the S election. There's some other nuances there to consider, but doesn't necessarily, the employees and subcontractors don't necessarily determine whether that makes sense or not. Okay. Now, do keep in mind that if you are just an LLC, the owner of an LLC is a disregarded entity, you are not going to pay yourself as the owner W-2 wages. That would only be the case if you make the S election. Do you then introduce that requirement where, as owner, shareholder of the business, you need to start paying yourself W-2 and running payroll for yourself or any other shareholders of the business. Let's see what else we've got. I think we have time for one, maybe two more questions. Yeah, this is a great question. We see this a lot. There's a few different rules of thumb. The question here is, how do I calculate a reasonable salary? The IRS provides this requirement, but there is some different rules of thumb and schools of thought around determining that reasonable salary. Definitely something that I recommend discussing with a professional. It's a little nuanced depending on the industry of your business, depending on the role that you have within your business. So, right, what do your day-to-day responsibilities look like as the owner of the business? Trying to create a baseline or level set that against what it might cost you to go hire someone to do that, right? What's the range there, the experience level, things of that nature. It's also a function of your net income, right? A business that has, say $500,000 in profit is not the same. What's reasonable for that business is not the same as what's reasonable for a business that has $100,000 in profit, right? So there's some things to take into consideration to arrive at that. I definitely recommend working with the professionals or team and discussing that for your business's unique situation to help dial that number in. Those were some great questions. I think we are at our time limit. We want to make sure we respect the time of our audience members, but not without saying thank you for joining. Thank you for the insightful questions. And we at Star Nsurance Tax, like I said, we love supporting small businesses. We love supporting our community, and we want to be there to have you covered and making sure that you can do that well and sustainably and with education and clarity as you go through the process. So don't hesitate to reach out and let us know how we can help. You can find us online at coveredbystar.com. You can also call our office or come on in for an appointment. Call us at 813-563-5577, and you can find us online via social media, TikTok, Instagram, and Facebook. Thank you for your time. We appreciate it. Get covered by Star. Take care.